This is chapter 14, and we're looking at creating and forecasting sales and financial needs for the future using financial reports. So we're going to use the percentage of sales method to do this. There are some limitations which you'll find in the textbook that explain what to be cautious about. And then we're going to look at how to prepare a cash budget and to use it to evaluate the amount and timing of a firm's financial needs. But first, let's look at the percent of sales method, and we'll go from there. Why would we want to do this, okay? Well, you're trying to figure out what the firm's future financial requirements are. Now, we know nothing stays static, so we want to grow, and we're going to predict what that growth is going to be. So we're going to project the firm's sales and revenues and expenses over a period of time. We're going to estimate the levels of investment in current and fixed assets that are needed to support those projected sales, and then we're going to determine if the firm's financing needs to be increased or what the financial needs are throughout that planning period. So the key ingredient to all of this is the sales forecast, okay, because it's going to be reflected in past trends in sales that are expected to carry out through into the new year, and new events that may happen that may change, increase those sales, or possibly even lower those sales. So in traditional financial forecasting, we look at expenses, assets, and liabilities, and we use percent of sales method to make projections of what the future may be. And that involves estimating the level of expenses in comparison to the sales, the projected sales. So let me show you right here. I'm going to explode this just a little bit, or blow it up so you can see it. And then I'll have to adjust it. Really adjust it. Let's go back here. Let's see if I can. There, how's that? So as you can see, okay, this is 2010, and we're projecting for 2011, and we're projecting, it looks like a 20% sales growth. So what we have to do before we do anything is find the proportions here and for comparability. So if my net income is what percent of my sales, and that comes up at 5%. Well, I'm going to use that, okay, when I get over here. So then you're going to come down and you're going to say, oh, current assets, I'm going to assume that that ratio stays the same. So I've got $10 million worth of sales. I'm going to divide my $2 million by $10 million and come up with a 20% ratio. I'm also doing the same thing with fixed assets. So that's a 40%. That's going to be 40%. And all the way down, you may look at it and say, well, long-term debt is not going to change. I don't believe I'm going to change my common stock or my paid-in capital, and my retained earnings don't play into this, okay? So you're going to calculate that when you get over to here, your increase. So let's go and see what happens when you get over here. Well, you're going to increase that $10 million by 20%, so you come up with $12 million. So over here, that 5% increase, or this 5%, so we're saying our net income is 5% of that $12 million, so I have $600,000 in net income. And then you just flow that down, okay, by taking these percentages and multiplying over. No change, no change, and this was a calculation and a plug number. So in this manner, you can fairly well suggest or predict what you may need to do in the future with this 20% increase in sales growth. You'll look at, well, my fixed assets went up $800,000. Am I going to have funds to take care of that increase? Do I have to borrow money? Am I going to have to look and come down and say, well, we need to increase our equity? So this type of financial forecast can give you some thoughts and benchmarks for the future of the year. So that's one way. The other way is this budget. And let me make that a little bit smaller. It's not overwhelming. So a budget is a forecast of future events, and it does three things. It looks at the firm's needs for future financing. It gives a basis for corrective action in case budget figures don't match. So you're watching along and all of a sudden things change, so you can go back and see what's going on the floor. Or you can use it for a performance evaluation and control. So the cash budget involves cash receipts, cash disbursements, net change in cash for the period, and then new financing if needed. And that comes down to this, and we're going to do one of these as an activity here. So let's blow this one up and see if you can see what's going on with this. So you can see we start off with our sales across the top. We put in our purchases that are going to be 75%. This has been traditional. So then purchases are 75% in 2 months. Okay, so you're going out. And then you're going to look at collections. And there's usually, you get 30% the first month, 50% the second month, and you see how they stagger down. And that's going to give us total cash receipts for each month. Then we're going to look at our cash disbursements, and we'll look at the purchases with a 1 month lag, okay, from row 4, which is right here. You'll add those up and you'll subtract them. Okay, we've got total cash, we've got total disbursements, and then we have a change. And then this was our beginning cash balance. So that means in the end we have $12,000 left. But look what happens for each subsequent month. There's not enough cash to cover all of these disbursements. So then you're going to come down here and say, oh, well, I'm going to have to do some financing across the board here. So that's how you use a cash budget. You know, it's very handy so that you don't get caught flat-footed. This just may be a downtime, and July may be your big month, and it kind of looks like the summer months are because you can see we went into a positive state here. So you're going to have to borrow money to get you through here or cut costs up here, one or the other, and then build up a surplus through the summer months. So very handy stuff to have. We're going to do one of these in activity, so I hope you enjoy it.